This was a little bit of a rollover, I suppose, in the rate of price increases, but there's still, Diane, a long way to go before the Fed gets anywhere near to its long-term goal of 2% inflation.
Exactly. We're several multiples ahead of what that long-term goal is, and I think that's what's important to the Federal Reserve. And so they have been, they've said, listen, we're going to have more measured rate hikes going forward, but that doesn't change the fact that we think we still need to go higher on rates than we did just a few months ago. And I think the market is losing sight of that. They keep waiting for the Fed to get to that point of saying, we're going to cut rates. We're still a long way from that point. And I think that's the part that gets lost in translation. The Fed was counting on the slowdown in goods prices that we saw in declines in things like used car prices that we saw to offset the inflation that we're seeing in the service sector.
And you still see pockets where the inflation is anything but kind of turning down.
Exactly. In fact, in shelter costs, we had the highest year-over-year increases in owner's equivalent rent and rents that we've had since 1982, and in rents, the highest on record. So I think that's really important to remember, that these are still very, very elevated rates. I do think that they'll come down more rapidly than the Fed thinks they'll come down because of the disorderly correction we're seeing in the housing market. That said, this is still not over in terms of a rate hiking cycle, and the Fed is still looking at tightening financial conditions, and they'll look at anything that looks like it's easing financial conditions and think they have to double down on the number of rate hikes, even if they're more measured.
Hey, Diane, Frank Holland here. Now, you mentioned what the Fed's looking at. What about these layoffs that we're seeing in the tech sector and other areas? Meta is obviously a headline one that we saw this week. Also, Salesforce and a number of other companies. Does the Fed actually pay attention to that along with the CPI data?
Absolutely. But I think what's important in terms of the tech sector is, first of all, they hired up rapidly. They've been on fire. And on the other side of it, I know many, many firms that are more than happy to snap up those workers. I have very strong doubts that they will be unemployed for any length of time. And that's the nature of the labor market we're in right now. And it's one of the things that the Federal Reserve is sort of struggling with, is that we still have a demand for workers, even though you have pockets that are weakening, demand for workers that outpacing the supply of workers out there by a significant margin. And so the Fed's watching that, but they're also watching what is the gap between the demand for workers and the supply of workers. And to narrow it, you got to both hammer demand, and ultimately what they have said is some pain, which is increasing the supply via an increase in the unemployment rate.
You've got the federal funds rate between 3.75% and 4%, probably moving another half point higher at the next meeting in December. Where do you think that number, which is really the number that the Fed controls, where do you think, well, look, there is the Fed rate outlook. Where do you see the terminal rate and when? We've got it there at 4.83% in May. Does that feel right to you? Do you think it's got to get above 5?
I think it's going to get a little bit above 5, and I think the Fed's going to be cutting sooner than they expect in the end of 2023. It is this concern the Fed has, and it's a rightful concern, learning from the mistakes of the past. If they don't eradicate inflation and get it down to a sustainably low level this time around, they risk a much more corrosive and longer bout of inflation that will require even higher unemployment and a deeper recession. So that's what they're all in on, and that's important to understand on their perspective. That said, I do think that some of the things that come off, we're bursting a housing bubble, a pandemic-induced housing bubble. As we burst that bubble, that kind of disorderly declines that we're going to see is going to follow through and show up in measured and in experienced inflation much sooner, I think, than the Fed expects.